Hello, and welcome to Nexus Real Estate Advisors. I'm Scott Lukes, its founder and president. Before today's video, make sure and go to our website, nexusrea.com, and download any of the associated presentations or papers for this video. From our resources page, you can find our resource library, which has a wide range of videos, papers, presentations, and other tools to help almost any level of real estate investor. Also, make sure and subscribe to our Facebook and Twitter to stay informed of when we have new editions, which happen almost weekly. Enjoy the presentation. Okay, let's get down to business. So in today's video, we'll talk about the depreciation expense as well as how to recapture that expense upon selling the property if we choose to do so. When we purchase a property, the IRS says, hey, listen, you spent X amount on a property. Part of it, the value is the land. Part of the value is the building. The Colorado Front Range, typically you'll find that the building is anywhere between 65-75% of the value and the land, the remainder. If you're in Maui, maybe it's reciprocal. Maybe it's the opposite. So this is one of the most important and often one of the most overlooked expenses, at least for beginning real estate investors, that we can use to our advantage. So let's talk in detail about depreciation. First off, let's take an example. We buy a property. It's $300,000. Let's assume that 2/3 of the value is in the building and 1/3 is in the land. So the IRS basically says that, hey, your building, if you do nothing to it over 27 and a half years, it's basically going to be unusable. And so every year we're going to deduct the building proportion of the total property value and give you a tax deduction on it. So in this case, we have a $200,000 building value divided by 27 and a half years gives us 7,273 depreciation expense every year. So that is a deduction from our ordinary expense or ordinary income on our tax return. So again, I'm in a relationship where my wife tends to think in terms of what are our after-tax dollars in pocket, Scott. So in this case, let's assume we're in a 24% federal tax bracket. What this looks like is that 7,273 depreciation expense is actually worth almost $1,750 in our pockets at the end of every year. But how do we find what the ratio is between our land and our building? Well, there are three mechanisms: the county assessed value, the appraisals, as well as comps relating to replacement cost and land sales. But by and large, where we all get our improvement ratio is a county website. So let me give you an example of how you do this. We're going to Google Arapahoe County. I know it's right there. Let me type Arapahoe County Assessor. Let's go to their website. I own a lot of properties myself in Arapahoe County. We're going to go to property search. Let's go down to residential. And let's, if you're lucky enough to know the easiest, type them in. But for those of us not, let's do the property in the example. And that's 725 Ursula. Let's search for that. And sure enough, pops up 725 Ursula with all the information that we need on the property to get our ratios. Let's hop back to the presentation. So this is what popped up on 725 Ursula. County assessor says that the assessed, not the appraised value, the assessed value, and this is just for taxes for the mill levy, 19,963 is the total, of which 13,492 is the building itself. So when we do the ratio of the building as a function of the total, we find that 68% of the value is in the building itself. So if we purchase the property for $300K, the depreciable cost basis, and that is the building portion, would be $300,000 times that 68%, leaving us $204,000. You take that $204,000, divide it by 27 and a half years, gives you $7,418 in the annual depreciation expense. So hopefully that makes sense. So that's the good part. Let's talk about potentially when we sell our property. So when we sell the property, all the tax savings that we enjoyed while we held on to the property, we have to account for when we sell it. So depreciation recapture is taxed as ordinary income up to a maximum of 25%, at least federally. State taxes vary. Colorado right now is 4.6. For me, being a mid and long-term buy and hold real estate investor, I've never really had to deal with this. Very rarely do you have to deal with this if you're a buy and hold investor. We can avoid this indefinitely by, if we sell a property, always rolling it into another property via 1031 exchange or another like exchange. But it all comes down to cost basis. And you've probably heard this term before. It's not super complicated. I'm going to draw a line up here, kind of by our logo. That's our sale price. So the sale price minus our basis right here, that's what we're taxed on for our capital gains, or for our gain when we sell the property. So in our example here, now follow closely. We bought the property for $300,000, and we already agreed that the depreciable cost basis, the value of the property, is $200,000, correct? We already agreed also that this is going to give us a 7273 annual depreciation expense. So after 1 year of ownership, it's going to reduce our basis now by that 7273 to this number. After 2 years, our basis is further reduced to this number. It's linear year after year. So you can imagine then, after 27 and a half years of owning our property, our cost basis for the property is effectively zero. It is zero. So when we sell the property, here's the thing to know. Again, up here is our line when we sell the property for $350 and we bought it down here for $300, right? If we lower our basis via depreciation, the distance between this line and this line is greater, right? And so we owe more taxes. Now, we can increase our tax basis by doing capital improvements, such as a deck, a roof, a furnace, things that typically are not expensable in the year that the improvement is made. This is unlike a garbage disposal repair or repairs. They're capital improvements, something that increases the value of the property. So raising the basis is a good thing. So let's take a look at how this affects taxes. So, and now we're talking again about selling a property, which again, I do not like doing, but let's take the example. Our purchase price was $350 or $300. After 2 years, our sell price is $350. We already know, so our initial basis was the $300,000 purchase price. Now I know I told you the $200,000 is the depreciable amount of the property, but the overall thing now is $300,000 is the initial basis of the property purchase. We had $5,000 of closing costs, which were not deductible. Now we've had our depreciation at a total amount of $14,546 for the 2 years, but we've added a deck, and that cost us $6,000, and we did not expense that in the year that we did the improvement. So our adjusted basis, our new basis, so it was $305. Now it's $305 minus. Remember, minus is bad because we have more room to tax between what we sold it for and what our basis is. So minus our depreciation plus our capital improvement gives us our adjusted basis of this amount, the 296. So now our taxable gain is very simply our sell price minus our adjusted basis, 350,000 minus the 296, giving us 53,546. So of this, the depreciation is taxed at a maximum of the 25%, and maybe some federal state also, and the remainder of the gain is long-term capital gains. So hopefully that makes sense. So that was a cursory treatment of depreciation. Again, we are not attorneys, we are not CPAs, and this is definitely a CPA question, if anything, and your CPA also should be able to help you with understanding what your current depreciation situation is for your properties. Some of the modeling tools that we have available help, especially the portfolio and analyzer, help you understand what your current situation with your property is in terms of the true after tax cash value for when you potentially sell your property. But all it's available up on our website. We appreciate you having tuned in to us today, and make sure and visit us again for our latest videos, papers, and other tools. From Nexus Real Estate Advisors, have a great day.